John Rothfield is Bank of America Merrill Lynch's chief economist for Australia, and he joins us now. John Rothfield, thank you very much indeed for joining us. Let's have a look at these numbers that are slightly worse than economists look for here, but really you can't read too much into that, can you?
No, I never thought I'd talk about a relief rally in markets after a minus 1.2% on GDP, which I think is the lowest since the first quarter of '91. With the upward revision to the prior quarter and a lot of folks in Australia having a minus 1.5% on GDP, the outcome wasn't as bad as some of the worst expectations, and domestic demand was quite strong. So all of that together led, I think, to some relief in what otherwise, from a headline, was a very bad number.
Right. Well, how's the Reserve Bank there interpreted? Do they look at the second quarter and say, well, of course, the first quarter was just a blip, but it's business as usual for the Aussie economy in the next 3 months?
Well, look, the Reserve Bank got this one wrong. We think that the Reserve Bank had about minus 0.5 in for GDP. Even though they expected about a $6 billion cut in real coal and iron ore exports, they got that part right, but there weren't as many offsets. However, if you think about the Reserve Bank's implied dual mandate, one is unemployment, that's only 4.85%, and their inflation outlook is above 3%. So the Reserve Bank doesn't think about these things mechanistically, but they would probably continue with their tightening bias despite this being a weak supply-related number. If demand is rising by almost 1% and supply is declining by about 1%, that's too much demand chasing too little supply. And if anything, it may actually increase the inflation outlook for Australia.
Right, well, let's also just see how, I'm going to return to inflation in a second, but I also just want to get your view as to what we have in terms of the two-speed economy there in Australia and how it plays into these GDP numbers.
Yes, it is true. The Treasury made the point in the budget that in the first mining boom Mark I, the exchange rate only averaged 75 cents. Also, commodity prices were rising at that time and providing an income boost. Right now, of course, the currency is over parity and commodity prices are arguably topping out right now, so you're not getting a positive income shock through the rest of the economy. So, look, it is a two-speed economy. Clearly not showing up in this quarter's numbers because of the downgrade to mining output and farm output because of the floods. But that's going to show up in the numbers going forward. It will be more of a two-speed economy in mining boom Mark II than it was in mining boom Mark I.
Okay, what happens with the central bank on the 7th of June? If we put out an interest rate hike, most people are suggesting there is going to be one, but not now until probably August.
Yes, that's right. Our view all along has been August, and the question is, do they tie it to inflation or do they get in a hike before inflation? And given some of these disappointing real side numbers, they probably do want to tie it to inflation. So we think the next inflation number in late July will vindicate the view that inflation over the next couple of years is probably going to be at or above target and would be the basis for a hike. Given, however, what's happening in other parts of the economy like credit, non-residential and other residential building approvals are weak, we're thinking possibly right now the Reserve Bank might be one and done on rates for this year and save up further ammunition until 2012.
With the Aussie dollar where it is at the moment, I think it's $1 US 7 cents. Isn't it doing the RBA's work for it?
Well, to some degree, although if you look at traded goods inflation, which is about half of the Australian CPI, that is also 3.25% right now. So what's happened is that the things that Australia imports, like food and energy, have actually risen in price by more than the Australian dollar has risen. Prices of clothing and household equipment has gone down, but the margins haven't come down. So traded goods inflation is actually 3.25%, just like domestic inflation. So the high currency has done some of the work for the Reserve Bank, but not enough to tip it back into a neutral bias.
John Rothfield, thank you so much for joining us. He's chief economist there for Australia, Bank of America Merrill Lynch.